So we've seen how to price bonds on the primary and secondary market, but there's one last thing that we haven't quite taken into account yet. So up until now we've been sort of assuming that when we price a bond that there is a single day in which the bond is sold and that's it. But the reality of the situation is that a bond is sold over a period of multiple days. So we're going to have a look at that today by looking at the trade and settlement dates on bonds and then discussing how this actually affects the bonds. So, I've just got a little timeline here. The selling of a bond you can sort of think of occurs in two stages, or on two key dates. The first date is when the two parties involved, the buyer and the seller, come together and actually agree on the terms of the bond. They agree on what the price is going to be, the face value, the coupon rate, maturity, so on and so forth. And they enter into an agreement that the bond is going to be purchased. And this is what we call the trade date. And this date I've put down here is just a sample date, though it is I'll get into this in a sec. So that's the trade date. The second date here is what we call the settlement date. So I mentioned that they come into agreement on the trade date about all the terms and the fact that the bond will be sold. This is the day when the actual payment occurs, when the buyer pays the seller for the bond and the bond is actually provided to the